Welcome to the Pro Ticker Deep Dive. If you spent any time tracking global energy markets recently, you really cannot have missed the incredible surge in the nuclear sector. We're going to deep dive into what we're calling the yellow cake phenomenon. I mean, this market-defying rally in uranium equities that has turned a historically quiet corner of the commodity world into an absolute focal point for investors.
It really is front and center now.
Oh, completely. We're talking about, just astonishing gains. You look at a company like Energy Fuels, a key player in the U.S.
Right.
They've seen their stock price gain nearly 300% year to date in 2025.
And that's not an outlier. The whole sector, the ETFs are up 50, 75%, sometimes more.
Exactly. So this kind of explosive, high conviction movement, it just begs a crucial question, doesn't it? Is this just a speculative boom, driven by short-term momentum?
Or are we really witnessing a generational shift in how the world powers itself?
That's the question.
And that is precisely our mission today. We need to go beyond the price charts and break down the foundational forces that are powering this momentum. The evidence, it strongly suggests the nuclear renaissance isn't just hype.
Okay.
The rally is fundamentally powered by the convergence of three major factors: relentless and accelerating demand, a definitive global policy pivot toward nuclear, and a global supply chain that is, well, it's years, if not decades, behind the curve.
And for anyone who might be newer to the space, when we say yellow cake, what are we talking about exactly?
We're talking about U-308. It's the uranium concentrate, the processed fuel source itself. So this isn't just about utility stocks. It's about the physical stuff that makes modern nuclear power possible. And it's suddenly a critical resource again.
Right. And speaking of that policy pivot you mentioned, let's look at the sheer scale of the political commitment that's now underpinning this whole thesis. I mean, for decades, nuclear faced, stagnation, existential threats. Now, policymakers worldwide are not just tolerating it.
No, they're actively promoting it.
They are actively pledging to triple global nuclear capacity by 2050.
It's an immense target.
And it's driven equally by ambitious decarbonization goals. We need reliable, carbon-free baseload power, and maybe more urgently, by these acute fears over energy security.
That's the key. Geopolitical reliance on, let's say, unstable regimes for fossil fuels.
It's a huge driver.
And if we look at the concrete actions being taken, this commitment feels very real. Right now, there are over 70 gigawatts of new nuclear capacity under construction globally.
70 gigawatts.
And the leaders are exactly who you'd expect. China is building at a breakneck pace, but the U.S. and Europe are also aggressively revising their strategies.
So how are they doing that? Is it all just giant new plants?
It's a mix of things. They're fast-tracking approvals for new reactors, sure, but they're also abandoning scheduled closures, bringing old plants back online.
Right.
And, maybe most importantly for the future, they're rolling out the highly anticipated small modular reactors, or SMRs.
The SMRs, right. These are the smaller kind of factory-built units that you can deploy more flexibly.
Yeah.
Exactly. Faster and more flexibly.
So when you put all that together and look at the projections, the change is just stunning. Global nuclear generation, and we're talking gigawatts electrical, the power that actually hits the grid.
The actual output, yes.
It's projected to jump from about 420 GeV today to potentially, 784 or even 1,240 GeV by 2050.
And even if you just take the low end of that range, you're still looking at a capacity increase of over 70%. This is a genuine structural reversal after 20 years of basically flatlining growth.
It is, but that ambition raises an immediate critical question. Is it even realistic?
That's a challenge.
Building a new large-scale nuclear plant has traditionally taken a decade or more. The industry has been paralyzed for so long.
It's a fair point. But that massive policy tailwind, it sets the perfect stage for the supply problem we're seeing right now.
So let's transition from those policy pledges to the hard commodity itself, the price.
The uranium price surge we've seen since 2024, it just feels like a textbook case of structural tightness colliding with this once-in-a-generation demand shift.
Absolutely.
We saw spot uranium prices almost double in less than a year. They moved from last year's lows near, $63 a pound, surged through $80 and are now sitting around $83 as of September.
And analysts are certainly not calling for a top there. The consensus view is we are quickly heading for that psychological resistance level of $90.
Maybe even $100 by year end.
Possibly even $100. And this scarcity premium is entirely rational because the supply side is simply, it's incapable of keeping up with this sudden aggressive demand.
Why, though? What's the core issue?
You have to remember the context. The mining sector suffered years of underinvestment when prices were in the basement. Mines were shuttered, put on care and maintenance.
So no new capacity was being built.
None. Now, mine output is running far below what's needed for the future, and restarting or building new capacity takes years and billions of dollars.
And it's not just a lack of capital, right? There are actual real-world disruptions compounding the whole issue.
Exactly. We've seen significant Canadian mine delays because of technical issues. We've seen sharp political disruptions in key producing regions of Africa that have taken huge volumes offline unpredictably.
And I imagine places like Australia are not exactly quick with the permits.
That's another one. Regulatory hurdles make bringing new supply online a painstakingly slow process. When you add it all up, the cumulative supply shortage is just staggering.
And the immediate consequence of that, it has to be panic.
It is. Utilities worldwide, who had previously run their inventories way down, assuming cheap fuel would always be there,
They're now scrambling to rebuild the stockpiles.
which creates a bidding war in the spot market. And on top of that, you have governments driven by those energy security fears, rushing to secure their own strategic stockpiles.
Specifically to get away from Russia and other riskier suppliers.
Precisely. So when utilities and governments are competing for the same finite amount of U3O8, the price really only goes one way.
This is where the story, for me, really shifts from the traditional nuclear narrative. It's not just about baseload utilities and climate change anymore.
Not at all.
We have to consider the modern, non-traditional demand sources that are adding this tremendous, sticky, upward pressure on the price.
And when we synthesize the new market data, we see four powerful interlocking drivers that are creating a sort of fundamental floor under the current uranium price structure.
Okay, let's break those down.
The first and maybe the most surprising one is AI and data centers.
Right.
Hyperscale cloud operators need enormous amounts of carbon-free baseload power. Think about the computational density required for training massive AI models. You need reliable power 24/7, 365.
And why is nuclear the preferred source for these tech giants? I mean, why not just build massive solar or wind farms?
It comes down to density and footprint.
Yep.
Nuclear offers that stability. It's baseload, and it requires a vastly smaller physical footprint compared to the enormous tracts of land you'd need for equivalent solar or wind.
So we're actually seeing them sign deals directly.
We are. Tech giants are bypassing traditional utilities entirely, signing direct power purchase agreements with nuclear providers. This is a whole new, deep-pocketed class of buyer in the market.
And they're not focused on price sensitivity.
No, they're focused on reliability and their zero-carbon credentials.
That shift, tech companies driving energy procurement, that's revolutionary. Okay, so what's the second key driver?
Driver number two is that energy security piece we touched on.
Mhm.
This goes beyond just replacing oil or gas. It's about national resilience.
Right.
As we discussed, governments in the US, the EU, Japan, China, they're all aggressively expanding or restarting nuclear programs because they see it as an essential strategic security tool. It insulates their grids from geopolitical manipulation.
And the volatility of fossil fuel markets.
Exactly. And driver three is, of course, climate commitments,
Right.
net zero pledges backed by new industrial policies. They're funneling record amounts of patient long-term capital into nuclear infrastructure.
And the expectation for SMRs in the late 2020s acts as a huge forward signal to the miners, right?
It's a massive signal. It tells them the demand is basically guaranteed for decades.
And finally, we can't ignore the financial plumbing that's also creating a kind of artificial scarcity. That's the investor inflows.
Absolutely. You have dedicated physical uranium funds and ETFs actively raising capital and just swallowing up large portions of the available supply on the spot market
Holding off the market for years.
for years. And this is complemented by large-scale retail and institutional investor interest flooding into the mining and royalty companies. All this capital is competing directly with the utilities and governments for the same finite product.
Okay, so let's circle back to the market performance. Energy fuels up nearly 300%, juniors up 150, 200%. The big question for any investor is, how sustainable is this parabolic move?
Right.
If the fundamentals are this strong, why did we see a violent pullback like that one in the first quarter of 2025? Doesn't that prove this is still a momentum trade driven by retail hype?
That's a crucial point. Volatility is a feature of any commodity market that's going through a dramatic repricing, and uranium is certainly no exception.
Yeah.
That correction in Q1 was sharp. It tested a lot of people's conviction.
It did.
But when we look at the bullish scenario, the long-term support factors are overwhelmingly strong. Persistent supply deficits, critically low inventories. That all favors firms with proven, permitted assets that can actually ramp up production.
And the new demand from data centers isn't going away?
It's non-cyclical,
Yeah.
unlocks durable growth, and the strategic stockpiling mandates, they act as a robust safety net, absorbing excess supply and limiting the downside risk for producers.
So even with the potential for short-term setbacks, the conviction remains high. What are the technicals telling us about where the price is headed?
The technical analysis really reinforces that conviction. Even after the volatility, the uranium spot price is in a clear, sustained uptrend.
Okay.
Analysts noted that the 200-day moving average, a key gauge of long-term institutional sentiment, held firm around $76.
So that's the new floor?
It suggests that the sophisticated money sees that level as the new floor, and it reinforces the idea that utilities are still actively moving to lock in higher-priced long-term fuel contracts. The next major psychological targets are exactly those $90 $100 levels.
And crossing that could bring in another wave of buying.
It likely would. Another wave of institutional buying that views uranium as having finally achieved critical mass as a strategic resource.
So what does this all mean for you, the listener, trying to navigate this new energy landscape? The nuclear renaissance seems to be far more than a hot investment trend. It feels like a foundational, generational shift that's reshaping the global energy and investment landscape at the same time.
I think that's right.
For uranium, this just means a fundamental, permanent repricing.
The tailwinds, policy urgency, energy security needs, and this unprecedented corporate demand from the AI world, they're durable and they are powerful. It all strongly suggests the yellow cake bull market is still in its early innings.
But the volatility is real.
The sheer speed of the run-up demands respect for that volatility. It requires both conviction in the long-term thesis and humility when you're facing those inevitable sharp corrections.
Ultimately, I think the most important question that will determine whether this growth story runs for 5 years or 50 years is this. Can the supply chains actually deliver?
Can they meet the demand?
Exactly. Can they deliver against this unprecedented policy and corporate demand? What structural changes will be required in mining, conversion, and refining to meet these ambitious tripling targets when the current infrastructure is so fragile? That's really the challenge ahead. See you all in the next Pro Ticker Deep Dive.